You know, to a lot of people, crypto trading feels like a total shot in the dark, right? Just a random bet. But for the pros, well, for them, it's more like a calculated hunt. So today, we're going to crack open their playbook. We'll look at the exact tools, the psychology, and the strategy they use to navigate and, profit from all that wild market volatility.
And look at this. It all builds towards this number. We're going to break down a strategy that some traders are convinced can turn just $800 into $100,000. I know, it sounds completely insane, right? But believe it or not, it's rooted in a really specific methodology that we're about to unpack together. All right, so here's the game plan for this explainer. First, we'll get a snapshot of the market. Then, we'll decode a pretty cool tool called the liquidation map. After that, we'll get into the art of adding positions, understand the core rolling position strategy, and finally, and this is a good one, we'll see how the US stock market fits into all of this. Let's get into it. Okay, first things first, let's set the scene. See, a pro trader isn't trying to watch the entire market. That's impossible. They focus. And in this case, our traders are zeroing in on two specific cryptocurrencies, and each one is telling a totally different story.
And you can really see the contrast right here. On one side, you've got Solana, and it is surging. Traders look at this and think whales, the big money players are pushing that price up. But then on the other side, you've got Ethereum. It's just consolidating, kind of moving sideways, building up what you could call potential energy. Now, for a trader, this isn't just random noise on a chart. Oh no, this is a clear signal of two very different opportunities.
So the big question is, how do traders get ahead of these massive moves? Well, it's definitely not guesswork. They've got a secret weapon, a tool that gives them a huge edge by showing them exactly where the market is most vulnerable.
The answer? It's a really powerful data-driven tool. Now, it can't predict the future, let's be clear about that, but what it can do is show where the market has weak spots, and because of that, where it's most likely to be pushed. It's called a liquidation map, and honestly, the best way to think about it is like a treasure map. Seriously. But instead of X marks the spot for gold, it shows where billions of dollars in leveraged bets are all clustered together. And here's the kicker. If the price just touches one of those zones, bam, all those trades get automatically closed, and that triggers this massive, powerful cascade of either buying or selling. And this is what leads to something called the whale hypothesis. It's basically a theory for how the biggest players out there go hunting. So they use this map to find a big, dense cluster of liquidations, then they take their position, and after that, they use their massive capital to just nudge the price just enough to hit that target. What happens next? It triggers an avalanche of forced liquidations, which pushes the price exactly where they want it to go, and they walk away with a huge profit.
And we're not talking about small amounts of money here. The scale is just staggering. I mean, look at this example. A tiny little upward move in Bitcoin's price would trigger over $10.7 billion in liquidations, and that's from short positions alone. So if you're a market whale, a target that big, that's not just an opportunity. It's pretty much irresistible.
Okay, so knowing where the targets are, that's one thing. But having a disciplined plan to actually act on that knowledge, well, that's what separates the pros from the amateurs. It's all about knowing exactly when to go all in, when to increase your bet. See, pro traders don't just throw more money at a position on a whim. They've got a very clear plan. Take Solana. They got in at 202, but they're not adding a single dollar more unless it breaks through that key resistance level at 221. It's the exact same discipline for Ethereum. This isn't about hoping for the best. It's a cold, calculated decision to only add more capital after the market proves their first move was the right one.
All right, and this brings us to the absolute core engine of their whole plan. This is the powerful idea behind that wild claim of turning 800 euros into $100,000. Let's dig into how they shoot for exponential returns, not just, slow and steady ones.
This quote from one of the traders, it gets right to the heart of the matter. He says, actually, our principal was only 800 U. Just by adding to the position twice, 800 becomes $100,000. So the magic isn't the initial 800 bucks. It's all about how they reinvest the profits. And this whole strategy has a name. It's called rolling a position. So, what is a rolling position? Well, it's a super high-stakes move. You take the profits you just made from a winning trade, and you immediately plow them right back into that same trade. Your position gets exponentially bigger. And think about this for a second. It's the exact opposite of what amateurs do, right? They add money to a losing trade hoping it'll turn around. Pros, they double down when they're right. They aggressively press their advantage. Okay, now you might think these crypto traders are just glued to their crypto charts 24/7, but they're actually watching a completely different market for clues, and it's one that operates on a good old-fashioned 9-to-5 schedule.
So why on earth are they watching the stock market? It's pretty simple. Markets are connected by human psychology. The same people and institutions are trading both. So when the US stock market opens strong at 9:30 a.m. Eastern Time, it creates this risk-on mood. Everyone's feeling good. And that wave of optimism spills right over into crypto. For a lot of these traders, a strong open in New York is just a simple, clear trigger to start buying.
So, when you put it all together, what we've really seen is a super methodical approach. This isn't about making wild, random bets. It's a real discipline that weaves together these technical tools, like the liquidation map, with a crystal clear strategy for when to add to a position, and on top of all that, a deep understanding of the market psychology that connects everything.
And that kind of leaves us with one last big question for you to think about. After seeing all the tools and the strategy behind a trade like this, what do you think really drives the market? Is it a logical puzzle, something you can solve with the right strategy? Or is it just a high-stakes game of human emotion?